Hi, this is Brett with Monarch Capital Home Loans, and today we want to talk about understanding costs associated with loans. I think this is one area that is just so confusing for a lot of people, and I think if we can just spend a few minutes understanding them, it will help immensely. I really like to think that in terms of three different kinds of costs that you will see. Again, on these disclosures, which are just ridiculous. There's page after page. They're very redundant. You're going to see hundreds of lines, but there's really only three kinds of costs. Number one are the fixed costs. And fixed costs have to do with just the cost to get any kind of home financing done. So for example, escrow. Escrow is a third-party neutral company that is going to facilitate the transfer of funds to make sure that the contracts go in all directions are correct and no money's lost or not accounted for. That's got to be paid for. Title insurance has to be done. On almost every loan, there's going to be an appraisal. So there's just some costs that are baked in. And while they can be negotiated at some level or shopped around for, generally speaking, they're pretty standard and they're fixed. Okay. The next one has to do with loan fees and commissions that are more or less tied to the bank or the broker that you're working with. We have other videos on the site that talk about the way this works. But again, anyone who's in the loan business is obviously trying to make a living doing it. And there's a couple different ways to get paid. Frankly, number one, we can charge the consumer, or number two, we can be paid on the back end of the loan, not being added to your loan necessarily, but being paid on the back end by Wall Street, or a combination of both. So you just have to realize that, even if you don't see any sort of commission listed, it's probably because Wall Street's paying the commission on the back end of the loan due to the rate that you are receiving. And again, we have other videos about that. But just be aware that, again, whoever you're working with, bank or broker, obviously they've got some skin in the game as well. And then finally, and this is the place where I think people get most confused, is prepaid items. So for example, this is money that you owe anyway, but you have to pay it up front in order for the loan to close. And so a good example of this would be taxes, for example, your property taxes. At different times of the year, property taxes are due. And even though you could, in a normal situation, delay your payment for some time, in a refinance, for example, you can't, because the state wants to see that those are being collected before you get the benefit of a refinance. There's also insurance, homeowners insurance and things like that have to be paid. And then the one that probably I think is the most confusing of all is prepaid interest. And so we want to try to cover this real briefly. But the thing to keep in mind is that you pay mortgage interest in arrears, meaning you pay behind yourself. So let's look at this calendar and let's think of making a June 1st payment. Now you might think that when you make your June 1st payment, you're paying for June. But you're not. You're paying for every day in May. Mortgage interest accrues daily, and when you make that June 1st payment, you're paying for all the interest that has accrued in May. So how much interest would you pay in a certain scenario? Let's look at one just to see if we can try to explain this a little bit. Imagine that your loan closes on the 13th of June, and you've already made your June 1st payment. What happens here? Well, if it's a refinance, you're going to have to pay the whole month of June. Your first payment date would be August 1st, not July 1st. You would skip the July 1st payment because it's being prepaid. So let me just try to break this down real fast. And again, you may have to watch this back a couple times. But the point is that if you close on the 13th, your new note, your new refinance is not going to start on the 13th or 14th. It only starts on the 1st of a given month. So they're going to skip ahead to the 1st here. Now, in order to skip ahead for the 1st and let the clock start ticking here, they've got to account for all this time, which is the full month of June. So you're going to prepay it, which is why you quote-unquote skip your July 1st payment and then you don't pay till August. Now, if it's a purchase, you didn't own the house from the 1st through the 12th, so there's no interest there, but you will obviously be in the home from the 13th to the 30th, and so interest will start accruing there. So you'll owe the 13th through the 30th, and then the same thing. Your first payment would be in August 1st, and you would quote-unquote skip your July 1st payment because you've prepaid it. Now again, I don't mean for this to be confusing, but there are just these three parts, and a good loan officer is going to help you understand all this up front so that there's no surprises. When you understand these things up front and you understand what the cash to close in is and whether or not you're rolling costs into the loan and so forth, generally it's not an unpleasant experience and everybody's good. But if you don't understand these moving pieces and your loan officer is not helping you with that, it can be kind of a surprise and it's not very fun. So hopefully this will help you dig into that a little bit and ask some good questions with your loan consultant, and they can set you up for a good experience here at Monarch Capital Home Loans. Thanks.